Hello, everyone, and welcome to another episode of Money Matters with Doug Jones, the personal finance show focused on moving you forward financially. I'm Doug Jones. And for today's show, I thought we'd focus on a topic that is got to be front of mind for absolutely everyone, and that is the real estate market. It's in the news all the time. We know people that are selling at record high prices. And with that super hot market, if you own a home, you're probably pretty happy because you're seeing an increase in your equity. But if you're not in the home market yet and are hoping to get into the home market, you're going to be a little bit concerned. Am I going to be able to get in? Can I afford a mortgage? How would I qualify for a mortgage? And so joining us today, we have a special guest. We have Sean Cooper. He's a mortgage broker, but he's also the author of a bestseller, Burn Your Mortgage. Sean, welcome to the show.
Hi, Doug. It's great to be with you today.
Oh, we're excited to have you talk to us. So I thought we should start by having you tell the viewers how you got into the real estate market and being a broker, but more importantly, that first home purchase and how quickly you were able to pay off your mortgage and how much you had for down payment.
Well, great question. That kind of all ties into one. So ever since I was younger, I knew I always wanted to own a property. Like, my parents were really my inspiration. They were always homeowners growing up. Even when they split up, they both managed to own properties, which I found quite impressive because a lot of couples that split up usually ended up renting, but they were both able to afford to own a property just because they put home ownership up above everything else. So they were really my inspiration. So pretty much as soon as I got my first part-time job, I started saving money towards a down payment of a property. And of course, I went to college and university and graduated, but I was always saving money for a property. So that eventually in 2010, I first started looking for a property, and I was able to save a quite sizable down payment, $170,000 down payment, which is a lot for a first-time home buyer. But I was just saving over several years, like over pretty much a decade. So I was able to save up a pretty big down payment, and it took me a couple of years or so to find an ideal property, not for a lack of looking, but just because it was a competitive market. So I ended up buying my property in August 2012 in Toronto for $425,000 for a detached house, which sounds like a pretty low price nowadays, but yes, you could get a pretty decent property back then. So when I bought my property, I knew that I didn't want my mortgage to be a life sentence. So I aimed to pay it down as quickly as possible and did that in several ways. I, for example, had like side hustles, like working as a freelance writer, as well as a money coach on the side. And I was able to double my income by doing that. So any extra money I had, I would make lump sum payments against the mortgage. And by doing that consistently over those 3 years or so, and just living frugally and not taking any extravagant trips or anything like that, I was able to pay off my mortgage in only 3 years and 2 months time. And my story ended up airing on CBC's The National, and it kind of went viral after that. So that inspired me to write my best-selling book, Burn Your Mortgage, which kind of talks about my journey to paying off my mortgage in a quick time frame like that. And it's not how to pay off your mortgage in 3 years, because I don't think that's realistic for a lot of people, but it kind of tells people some tips that they can apply to their own life to save towards a property sooner and pay off their mortgage sooner. And then I got so much great feedback from that, and I had a financial background that I decided to become a mortgage broker, and I've been doing that for the last 3 years, and it's been really great to be able to take the next natural step in my career and help people with their mortgages and help people burn their mortgage sooner. So that's kind of, in a nutshell, how I reached to where I am today in my career, and I just find it so rewarding to be able to give back and actually help people burn their mortgage right now.
Well, so I'm some of the ages, you were 27, I know, when you purchased the home, and so you had the home paid off by the time you were 30. And, you know, it's
Yes.
remarkable that you had $170,000 saved at age 27 and, you know, had university expenses and everything else in there. And then to pay off the $255 of mortgage in 3 years, again, shows a real dedication. So clearly you had some strong goals set in achieving that. What were some of the challenges you encountered?
Sure, it wasn't all sunshine and rainbows. I certainly ran into challenges along the way. Another way that really helped me pay down my mortgage sooner was by renting out my property. So by most people, when they rented their property, they would probably rent out the basement. But I took it a step further. Like, I heard of Scott McGillivray from Income Property, the TV show, and his story really inspired me. He said he lived in the basement of his house for 8 years and rented out the upstairs. So when I heard that story, I'm like, why don't I do that myself? I can earn double the rent by renting out the main floor of the property. So that's what I did, and that really helped me pay down my mortgage a lot sooner, because I'm living on my own and I just don't need all that space. Like, of course, that's probably not practical for a family, but for somebody just starting out living on their own, I think that's a good way to pay down your mortgage sooner. So by doing that, I was able to help pay down my mortgage sooner, but it didn't all go perfectly. But like, my first tenants were great tenants. They paid their rent on time and took good care of the property. But my second tenants, things didn't go so, like, unfortunately, they ended up getting divorced while living at my property, and they did a bunch of damage to the property. Like, I guess they had fights and slammed the door and made holes in the walls and did a bunch of damage, but luckily nothing major like that. But yeah, they were late on their rent several times. So it didn't go all perfectly. And yeah, I had surprise home repairs. This kind of underscores the importance of having emergency fund. Like, I woke up one morning and I had like flooding in the basement just because of like the whole freeze and thaw cycle of winter. So I had to get like renovations done, like a walkout from my back of the basement there. I had to spend like over $10,000 getting the walkout redone at the back of my property. So certainly things didn't go perfectly, but thank goodness I had an emergency fund and I was financially prepared for that, because otherwise I would have had to go into debt. So that definitely underscores the importance of, when you're buying a property, it doesn't make sense to put every single penny towards the down payment. You definitely keep an emergency fund, I would say. It depends on the individual, but $5,000, $10,000 at least, maybe up to $20,000, depending on how risk averse you are. But definitely don't put every single penny towards the closing costs and down payment, because there are those surprise expenses that come up. Like, maybe if you're buying a new property, there might not be big repairs like that, but especially when you're buying a resale property, make sure you have a decent size emergency fund, because you don't want to have to go into debt with these surprise expenses that come up when you become a homeowner.
Well, I think that's great advice. And that's something else I saw in the book is, I talk to people about their finances and budgets all day long, because that's what I do. And that's what I saw in your book is, and I saw the advantage of your book, not just to burning your mortgage, but actually the principles applied to saving up your down payment if you're still waiting to get into the market. So can you get into, like, you actually talk about monthly income and expense trackers and things that I do with people all day long. So maybe you could go into that, the importance of that sort of budgeting, money tracking, and the benefits to saving your deposit money or paying your mortgage earlier.
Sure, definitely. So I find like it's pretty much a no-brainer to keep track of your spending and income, because it's really a great way to keep yourself accountable, because a lot of people, they get a lot of anxiety. Like, survey after survey shows that people are really anxious about retirement. It's just like a faraway concept that it's hard to really visualize. And I find the same thing with like paying off your mortgage. Like, if you're taking a 25 or 30 year like mortgage out, 25 or 30 year amortization out, then like that's a long time away that you might be paying it off in full. So it's kind of hard to visualize that, but certainly by tracking your expenses and kind of keeping an eye on your finances on a daily or monthly basis, it really helps keep you accountable. And you can set yourself goals on like an annual basis. Like, for example, there are great mortgage calculators out there. You can work with a mortgage professional like myself, but you can basically like figure out how soon you want to pay down your mortgage. Like, if you want to pay it off instead of 25 years, you want to pay it off in 15 or 20 years, how many extra payments that do you have to make? And then you can work your way backwards. By having a proper budget, you can figure out exactly where your money is going and perhaps places you can cut back on your spending to be able to come up with that extra, like, for example, $5,000 a year you want to make in prepayments. So it really comes down to budgeting and tracking your expenses. And I would just say, figure out like what works best for you, whether it's pen and paper, Excel spreadsheet, or there are great budgeting apps out there like Mint. So figure out the way that works best for you and just stick to it, because if you write a budget and you just stick it in your drawer and never use it again, it's not very useful. But if you find a way that, where you consistently track your spending and look at it on a monthly basis, that's where you're really going to get value. So yes, by kind of putting those steps in place, those checks and balances, and being consistent with your finances, that's where you can really reap the rewards later on by paying off your mortgage a lot sooner.
So maybe you could get into, in terms of paying off your mortgage earlier, in your book, you have sort of your 5 top tips for burning your mortgage quicker or retiring it sooner. Maybe you want to go through those 5 criteria for people. You've mentioned a couple already in what we've talked about. Sure.
So in terms of paying off your mortgage sooner, there are many. I go through like almost 10 different ways in my books, but I'll go over 5 of the different ways. So the first way is to make lump sum payments with what I like to call found money. So found money is stuff like refunds, bonus at work, or inheritance. So that extra money that just comes up out of the blue, you can make lump sum payments on your mortgage. You don't necessarily have to use all of it, but at least use some of that money to make extra payments on your mortgage instead of just spending the money. I mean, certainly it's okay to have fun with it, but by putting some of it against your mortgage, you can get it paid off a lot sooner, because a lot of people struggle with coming up with extra money to put against their mortgage, and that's a good way to do it. Another way to pay off your mortgage early is by accelerating your payments. So normally the default option with your mortgage is like monthly payment frequency, but by paying it on an accelerated basis, either weekly or bi-weekly, you can pay it off a lot sooner. Basically, by paying it accelerated weekly or bi-weekly, you're making a slightly higher mortgage payment, and you're making the equivalent of 13 months worth of mortgage payments instead of just 12 months. So by making those extra payments, that can really help you pay off your mortgage a lot sooner. And I go through examples in my book with actual numbers, but that's a really powerful way to pay off your mortgage sooner. Another way you can pay off your mortgage sooner is by going with a lender with generous prepayment privileges. Like some lenders have really restrictive prepayment privileges. They only let you make like lump sum payments once a year, but working, like if you mention to your mortgage professional, mortgage broker that prepayments are important, they can help match you with a lender that has generous prepayment privileges so that you can pay down your mortgage a lot sooner, because if they're really restrictive, then you're not going to be able to do that. The fourth way is by not paying a ton of fees and penalties. So Canadians love their 5-year fixed rate mortgages. Like that's by far the most popular mortgage term out there. But the problem is if you end up paying a huge mortgage penalty later on, it's going to be a major setback to paying down your mortgage sooner. So you might pay a mortgage penalty because you decide to move properties in the middle of the mortgage term, or you refinance the property to pull out equity for renovations, or you sell your property to move to another town. There's many different reasons. 5 years is a long time. So if you like the 5-year fixed rate and you're worried about penalties later on, then your mortgage broker could help you match you up with like a fair penalty lender where you're not going to face a big penalty like the big bank. They use a posted rate of almost 5% to calculate their penalty, where you can end up with like mortgage penalties in the tens of thousands. So if you have to pay that, it's certainly going to be a big setback. So definitely ask about penalties up front, because who knows what will change in the future. And another way to force and the fifth and final way to pay the mortgage off sooner is by shortening the amortization period of your mortgage. Like you don't necessarily have to go with a 25 or 30-year amortization. You could even go with like a 20-year amortization. Just make sure you can handle the higher payments, but that's certainly a way to force yourself to pay off your mortgage sooner. Those are the 5 key ways to do it.
Well, thanks. So we're going to take the break right now. And when we come back from the break, let's get into is now the time to jump into the mortgage? How do I qualify for a mortgage? And what are the benefits of working with a mortgage broker? So when we return, we'll cover those topics.
This program is brought to you by Ignite TV. Now you're in command. Visit Rogers.com for more details.
For 25 years, you've been helping to make our roads safer by doing the right thing. You've been the designated driver, you've stayed over, called home, you've called a cab or a friend, and planned ahead. Let's keep doing the right thing. Support sober driving by getting yourself and your friends home safely.
Do the right thing.
Visit ArriveAlive.org to find out more. Arrive Alive. Drive sober.
It's so inspiring to know that there's people out there that are willing to help people who've gone the situation that I've gone through. Because of United Way, I'm able to stand in front of you today with a good job that I can actually make something of myself.
Well, welcome back to Money Matters. Before the break, we were talking with Sean about budgeting and how to pay off your mortgage quicker and also save up for a down payment. So I thought now we should turn our attention to, we know the market is super hot. Sean, what advice do you have for people on entering the market now with it the way it is right now? Is now the time to enter the market?
Sure, that's definitely a great question that you asked. I mean, it depends on whether you're financially ready to buy a property. Like, certainly just because you can qualify for a certain amount of mortgage money doesn't mean you're technically ready to go out and buy a property. You have to actually sit down and look at your budget and make sure that you can afford the monthly carrying costs of the property. Because, for example, when a mortgage professional looks at the various debt ratios that you have to qualify for, it doesn't account for things like childcare costs or other expenses that you might have. So it's important to sit down with a mortgage professional, find out how much you qualify for, and then actually plug those numbers into your own budget and make a hypothetical budget for when you will own a property and make sure that it is affordable for you. So once you've done that and determined that a property is affordable for you, then before looking at properties, I'd certainly recommend sitting down with a mortgage professional, getting pre-approved for a mortgage, and just having that letter ready so that, like, when you're ready to make an offer on a property, you could do that with confidence. And yes, I mean, low interest rates are a bit of a double-edged sword. Like, certainly it's beneficial to paying down your mortgage sooner, but it also causes home prices to go up faster. So, I mean, I wouldn't read too much into the headlines. Like, experts have been calling for a real estate bubble for as long as I can remember, pretty much since the last real estate bubble. It's happened over like 20 years ago. So honestly, I would just kind of try to tune that out, because if I had to listen to the experts back in 2012, I wouldn't have bought my house. And now my house is worth like $1 million. If I had to just rent it all that time, I wouldn't be able to afford to house these properties these days. So I would just buy when I'm financially ready. And the most important thing is, like, it's the time in the market. I wouldn't necessarily try to, again, referring back to Scott McGill's great saying, it's not about timing the market, it's about time in the market. So I would buy when it makes financial sense for me. I wouldn't necessarily be worried about headlines out there. Like, interest rates are still super low, so I definitely think it's a unique opportunity to get into the market and lock in a 5-year fixed rate at like historically low levels. So if you're financially ready and it makes sense from a lifestyle perspective, I definitely think now is as good a time as ever to get into the real estate market.
Okay, so you touched on an important part there to me, which was the affordability. Like, go and see if you qualify for the mortgage before you sort of go out. Because of course, if you go out and sign to purchase a home with no terms and no conditions, and then you can't get the financing, you open yourself up to some litigation issues. So the question for you as a mortgage professional is, what are lenders looking for? What should people be focusing on to make sure they're getting ready to enter the market?
Sure. So I always, like, as a mortgage broker myself, I always sit down with clients and make sure that they're financially ready before they go out and look at properties. Because unfortunately, as you mentioned there, Doug, there are some people that just go out and make an offer on a firm offer on a property with no conditions, and they haven't even sat down with a mortgage professional, if you can believe it. And then if you don't complete the transaction, you can lose your deposit and get sued. So certainly I don't think anyone would want to go through that kind of stress. So in terms of getting ready to be buying a home, definitely get pre-approved with a broker like myself. So what that involves is taking a snapshot of your finances, looking at your income as well as your down payment, your assets, and any debts that you have, and also how much you would like to spend on a property, because you have to factor in the mortgage size, the property taxes, and the maintenance fees if applicable. So it's definitely important to sit down and look at all those numbers to make sure that your expectations in terms of buying a property and what you can actually qualify for are in line. Because if you want to spend $1 million on a property, but you're only qualified to spend up to $500,000, there's a bit of a disconnect there. So definitely important to sit down, have the conversation, and especially on the credit component, make sure that everything's looking good in terms of your credit, because like you don't want to wait until the last moment to pull your credit and have that pulled once you've made a firm offer on a property and realize that something is out of date on your credit report or there's an error or something like that, because that could take like potentially a couple of months or longer to correct with the credit bureaus, acts in TransUnion. And when you're in a time-sensitive situation, like making an offer on a property, you don't have a ton of time to get stuff like that resolved. So definitely speak with a mortgage broker or mortgage professional early on, get them to run the numbers and review everything in advance. The only missing piece of the puzzle will be the property itself, but by doing that due diligence up front, you can avoid that stress later on and you can set yourself up for success and be ready to hit the ground running to buy a property when you see a property that you like.
Yeah, and I would add to it that I think the credit component is very important because people need to realize that is something that's going to be looked at. So if you're thinking about going into that market, talking to someone like yourself is important because you might understand that, well, I had a problem a year ago on my credit bureau it's not factually incorrect. It's an accurate statement that may affect your ability to qualify right now. And again, that it's important to make sure you're going to qualify for that mortgage. Maybe you can explain to the viewers the difference between sort of pre-qualifying, pre-approved, approved, because there's a lot of terminology there that people might be mixing up.
Sure, great point there, Doug. So pre-qualification is really just entering some hypothetical numbers into a mortgage calculator online and just determining that you qualify for the mortgage based on the numbers that you enter. If you're more serious about buying a property, definitely a good idea to take it to the next step, pre-approval, which is basically having a mortgage professional like myself look at like actual documents like job letter, most recent pay slip, as well as your credit, and just making sure that it's in good shape at that point in time. But the missing piece of the puzzle is the property itself. So the lender also needs to sign off on the property. So the pre-approval isn't a complete approval. So you can't actually get a mortgage approval until you've made an offer on a property and it's been accepted conditionally, or it's a firm offer with no conditions at all. So that's kind of the difference between them. Like just because you have a pre-approval isn't 100% guarantee that you're going to get it approved, because there could be potential issues with the property, but it definitely helps mitigate your risk substantially. So definitely sure to get pre-approved. And if you want to further protect yourself, you can include conditions like condition of financing and home inspection. But I realize the market's pretty competitive right now, so that may not be realistic, but definitely get pre-approved so that you're ready.
Yeah, and I've read some articles recently that said because of how hot the market is, we're getting into these extreme bidding wars. And so one of the articles I was reading was saying that people are getting caught because they think they know what they can afford on their mortgage. But they're getting into a bidding war and they're bidding up a premium that is significantly over what the lender then appraises the house at. Therefore, in order to qualify, they need to up their down payment money, which can then create some challenges. How would you address that?
Sure. So yeah, that's definitely a challenge in this market. Like homes these days are setting all new records for streets and neighborhoods. So I definitely see that all the time. What I would say is make sure that you have a bit of buffer if you're going to be making an offer on a property and kind of setting a new benchmark for the neighborhood or street. So if you're just making the minimum like 5% down on a property under $500,000, I would definitely be cautious about how much I'm offering on a property, because if the property gets appraised at a lower amount, you have to make up the difference or else you're not going to be able to close. So definitely have some sort of buffer in terms of the property. Like if you're going to make a 25% down payment on the property, you have a bit of buffer. Like even if the property gets appraised so that your down payment is less than 20%, still you have a bit of buffer, because you can, if it's under 500,000, you can make as little as a 5% down payment. But yeah, I would definitely say like be careful when you have the minimum down payment, because you will have to make up the difference if it gets appraised at a lower amount. And if there's any concern in terms of that, like a mortgage professional like myself, we have access to tools like Purview, which looks at comparable sales to make sure that the amount that you're going to be offering on the property is reasonable. So yeah, I mean, just make sure you have a bit of extra buffer, because if you don't, then that's when you can get yourself into a bit of trouble in terms of not being able to close if you can't come up with that extra down payment amount in a situation where the appraisal comes in a bit light.
So before we run out of time, there's another thing I recommend to people all the time. It's if they're talking about getting into the market, I always tell them, go see a broker. And then they'll say to me, well, no, I know my bank guy. I'm just going to go to the bank and talk to them about my mortgage. And I keep saying to them, no, you're going to do better if you talk to a broker. So, Sean, can you explain to us the benefits of working with a broker?
Sure, of course. That's a great question. Like when I was going to take out a mortgage myself, same thing. I was just going to go to my local bank branch, but then I found out about the benefits of working with a mortgage broker, and that really changed my mind, and I ended up getting a mortgage with a broker myself. And that great experience several years back always interested me in the industry. So when I decided to become a mortgage broker like myself, it was great to be on the other side of the table helping Canadians. So the benefits of going with a mortgage broker, and I outline them in my book, but I'll just go through them now for your viewers. So when you go to the bank, they're just one option. Like I just find if you go and look at one option, you're not really doing your due diligence. Like if you were to buy a vehicle, I don't think you would just look at one vehicle and go to one car dealership. You'd really want to do your due diligence. So when it comes to borrowing the biggest amount of money in your lifetime, I definitely think you should do some sort of due diligence. I mean, when you're planning a vacation, I'm sure you look at different places to stay at. So it only makes sense with your mortgage. So when you go to the bank, especially in COVID times, it's not so easy to visit bank branches. Whereas with a mortgage professional like myself, mortgage broker like myself, I have access to and relationships with dozens of lenders. So when you go to the bank, they're just one lender, and they're not going to say, like, go down the street to your competitor. They have better products. You really have to do your due diligence. And I find that they're not necessarily giving you a fair picture of their mortgage products, because they're only likely to tell you about the benefits of their product. They're not necessarily going to tell you about the negatives of their product. Whereas like myself, I have dozens of lenders. So I ask my clients like what they're looking for in a mortgage product, like whether it's good prepayment privileges. I think everyone wants competitive rates, but mortgage penalties like is a big item. And I just kind of understand how long term my clients want to stay in the property, and then I can set them up with a lender that isn't necessarily going to have penalties like the big banks, because the big banks definitely have, they may offer you competitive rates, but their penalties definitely can be on the higher side there. And a mortgage broker like myself, it doesn't cost you anything extra to work with a mortgage broker like myself. I'm paid by the lender for introducing you as a client. So you save time and money by working with myself.
Well, Sean, thanks for joining us today to discuss the burning your mortgage with the very, very hot real estate market we're in. That was great information for everyone. Viewers, thanks for joining us again today. If you have any questions or comments on the show, or you'd like to suggest a topic for a future show, you can reach us by going to Rogers TV. Click on the link for this the homepage for this show, and you'll be able to submit questions to us. Until next time, thanks very much.